So today I would like to analyze PayPal because in 7 days they will present their earnings and they expect less earnings per shares than 1 year before. They expect a higher revenue and the shares is dropped over the 5 years about 47%. And if we look at the all-time high in 2021, it looks even worse with the 80% drop. So it looks cheap from the chart. So it could mean it's undervalued right now. But I want to take a look at the financials and then have a decision if I would buy or invest in PayPal right now. The first thing we are realizing is they have a market cap of 63 billion, and that's quite cheap compared to the other bigger companies like Google and Amazon and Microsoft. So it's looking interesting to buy, but I want to take a look at the financial foundation. So for me, the first thing what is very important is the revenue growth. So if we take a look here, we can see from 2019 it did grow about 22%, and then again 19%, and again 5 and 9%. So that's looking really good. Actually, over the years they could have a very good revenue growth. So it's a check here. So the next thing we are looking for is free cash flow. So we want the free cash flow to grow over the years. We want to have the money that comes in growing. So the free cash flow is very important because this is how they buy back the shares and also can pay the dividends. So if we take a look here, we can see it was at 3.86 billion in 2019. It did grow again, and then it declined and declined again, but we are still up over the 5 years. So for me, that's still good, and we have still the free cash flow growth over 5 years. So it's a check here. So the next thing I'm looking for is free cash flow yield over 4%. So this can indicate the value of the company, if it's undervalued or overvalued. So if it's over 4% free cash flow yield, that could mean they are undervalued, and if it's lower than 4%, it could mean they are overvalued. So let's take a look at PayPal right now. So we take the 4.22 billion and we divide it by the 63 billion market cap, and then we will get the free cash flow yield. So that's about 0.0669. So this means 6.69% free cash flow yield, which actually looks amazing. This is a lot of free cash flow yield. So okay, so they can use the money to buy back shares or invest in their business, or even could pay a dividend, which I don't think they will do. They will rather buy back shares, but it's look really good. So it could mean they are undervalued right now. So it's a check here as well. So the next thing very important for me is debt to free cash flow under 5. So this means they can pay back the debt with the free cash flow in 5 years. So this is what we are looking for, because if they have too much debt and they cannot pay it back, this is how the company could die or go bankrupt. So we want this under 5. So we take a look at the debt and we look at the long-term debt here. So it's around 10 billion. And then we take a look here at the short-term debt as well. This is 1.39. So we add it up, and then we divide it with the free cash flow, 4.22. So what do we get? Okay, so we got 2.69, and this is actually amazing again. So in under 3 years, they can pay back the debt with the free cash flow. So it's looking really good actually. And we can also take a quick look at the cash on hand, because obviously this is how they also pay back the dividend or buy back the shares. And they have 14 billion in cash on hand. So they have a lot of money in the bank, and they not have so much debt. Actually, they can pay back the debt with the cash on hand already. So they can use this money to buy back shares and or pay the dividend, which I don't think they will do, but this is looking really, really good actually. So they have a lot of cash on hand. So this is a check mark here as well. So the last thing I'm looking for is shares outstanding decrease. So when they're already a accomplished company that is on the market many years and they have a positive free cash flow, I also expect that they buy back shares. So obviously when the stock price is too high, it's not really good for them to buy back shares because they buy back the shares expensive. But PayPal looks undervalued, so if they buy back shares, it's very good. So if we take a look here, we can see they did buy back shares over the years. So they did buy back shares even in 2016. So at this time, probably the price was too high where they did buy back shares. But now in 2022 and 2023, they did buy back a lot of shares here, even over 5%. And I think this was a good time to buy back shares because right now they seem undervalued. So this is something good to see. They buy back shares. So that's great. And it's a check here as well. So I would like to give a quick conclusion if I would buy PayPal or not. So let's talk about it. So the first thing would be competition. So that's the negative thing about PayPal, because they have a lot of competition. Let's say Google is also trying to go in the business with the Google Pay. Apple is doing the same, Apple Pay. And there are many other companies that do similar things like PayPal. So that's definitely a problem for them. They have a lot of competition, but they also have a good reputation, and still a lot of people use PayPal because they trust them. And I do believe they still have an important place, but the competition is very strong too, so we have to consider that too. But it's looking like a very good buy to me because the financials are great. They have a free cash flow yield over 6%. They have a lot of cash on hand, and the stock price is looking very cheap. So personally, I think it's a good buy, and I also expect they will have a good earnings. I actually do believe that. But I also think if you really want to hold it very long time, there are definitely risks with the competition. But if you want to hold it maybe for some months or maybe for a year, I think it's a good recovery play, and they will buy back more shares because they have a lot of cash and they have a good free cash flow. So I think the stock price will increase, and maybe it will go back to the like 80 euro levels or even above that. But I believe it's a good recovery play, and I think the earnings will be good as well.